If you own a business, whether it's a solo operation, a small partnership, or a growing side hustle, you probably already know this. Taxes are one of your biggest expenses, and for a lot of people I talk to, they feel unpredictable, frustrating, and just way too high. Now, here's the thing. Most business owners I meet aren't doing anything wrong, but they're also not doing enough on purpose because the tax code isn't just a rule book, it's a map. And if you understand it or work with somebody who does, there are legitimate IRS-approved ways to reduce your tax burden year after year. We're not talking about loopholes. We're talking about smart legal strategies that are designed for business owners like you, such as choosing the right business structure, using retirement plans to your advantage, and timing your income and expenses the right way. And yes, taking deductions you're actually entitled to, even if you've been too cautious to use them. I had seen clients save thousands just by making a few small shifts. So if you've ever felt like you're doing all the work, sending half your profit to the IRS, and wondering, is there a better way? There is. Let me show you how. If you're new here, I'm Pete Masani, financial planner with Income Security Associates, LLC. For over 20 years, I've helped business owners and professionals create retirement plans that are tax smart, value driven, and built for long-term peace of mind. If this kind of strategy-focused content is helpful to you, go ahead and like, comment, or subscribe so you don't miss the next video. So let's dig in. Let's start with something foundational but incredibly important. How your business is structured has a major impact on your tax bill. And yet, I meet a lot of business owners, especially self-employed, who set up their LLC or sole proprietorship years ago and haven't revisited since. But here's the thing. As your income grows, the way your business is taxed might be costing you more than it needs to. Let's walk through a couple common setups. If you're a sole proprietor, all of your net business income gets taxed as personal income, and you're on the hook for self-employment tax. It's simple, but not always the most efficient. If you formed an LLC, that gives you legal protection, but from a tax perspective, it's still treated like a sole proprietorship unless you've made a specific election. Now, here's where it gets interesting. You can choose to have your LLC taxed as an S. Why does that matter? Because now you can split your income between a salary, which is subject to payroll taxes, and distributions, which are not. That move alone can save thousands in self-employment taxes legally. Let's say your business nets $200,000. If you're a sole proprietor, all of it is subject to self-employment tax. But if you're an S corporation and you pay yourself a reasonable salary, say $100K, only that portion gets hit with payroll taxes. The rest is still taxed as income, but it skips that 15.3% self-employment tax layer. Now, this isn't a one-size-fits-all recommendation. There are additional costs, like payroll filings and corporate returns. But for many successful business owners, especially in the 100 to 300K income range, it's a strategy worth looking at. The bottom line, your structure affects how you're taxed. And if your structure hasn't evolved with your business, there may be savings you're leaving on the table. Coming up next, we'll talk about one of the most overlooked tools business owners can use to reduce taxes and build long-term wealth: retirement plans. If you're a business owner, you probably already know that saving for retirement is important. But what you might not realize is just how powerful retirement plans can be as a tax strategy, especially when you own the business. Here's the truth. Most people think retirement accounts are just for employees, like 401ks at big companies. But if you're self-employed or running your own business, you're the employer, which means you have a whole menu of options to not only save for your future, but reduce your tax bill right now. Let me walk you through a few of the best options and how they actually work in practice. Number one, an SEP IRA. Simple and generous. It's one of the easiest retirement plans to set up, and it's ideal for solo business owners or small businesses with just a few employees. In 2024, you can contribute up to 25% of your net earnings from self-employment, up to $69,000. Your contributions are tax deductible, which means you lower your taxable income right away. You don't have to contribute every year, and that's great if your income fluctuates. Let's say you net $200,000 from your business. An SEP IRA allows you to put away up to $50,000 of that tax deferred. That's a huge immediate write-off and a serious boost to your retirement. A solo 401k. You can maximize contributions. If you're self-employed and you don't have any full-time employees besides a spouse, a solo 401k might be your best option. It allows you to contribute both as the employee and as the employer. In 2024, you can contribute up to $23,000 as an employee or $30,500 if you're over 50. Then as the employer, you can add up to 25% of compensation. Total combined contribution limit again is $69,000 or $76,500 if you're 50 or plus. You could also include a Roth component, contributing after tax now for tax-free growth later. It gives you more flexibility. Why it works? It is a high limit, low cost plan for people with good income and no staff. You get a big deduction and you keep the money working for you. If you're in your 50s and 60s, and your income is strong, a defined benefit plan can allow you to contribute well into six figures per year. Think of this as a pension you put up for yourself. Contributions are based upon your age, income, and how long you plan to fund the plan. It's ideal for business owners looking to make up for lost time or reduce a large tax bill quickly. Example, let's say you're 60 and your business is netting $300,000 annually. Depending upon your circumstances, you might be able to contribute $100,000 or more per year into this plan and then fully deduct it. These plans are more complex and requires actuary, but the tax savings are massive. These just aren't retirement savings tools. They are tax strategy tools. If you're paying $30K, $50K, or $100K in federal taxes each year and not using these accounts, there's a good chance you're overpaying. And remember, once that tax year ends, these savings are gone for good. You don't get a redo. So whether you're trying to grow your net worth, reduce your tax liability, or both, using retirement accounts as part of your strategy gives you long-term leverage. And that's just smart business. Coming up next, we look at the deductions most business owners are missing and how to use them without raising red flags. So let's stop missing deductions. These are the ones that count. Here's one of the most common things I see when I sit down with business owners. They're so afraid of doing something wrong that they end up leaving perfectly legal tax deductions on the table. And I get it. No one wants to raise red flags with the IRS. But there's a difference between being aggressive and being strategic. So let's talk through some of the most valuable and commonly overlooked deductions business owners are allowed to take. 1. The home office deduction if you qualify. If you regularly and exclusively use part of your home for business, you can deduct a portion of things like mortgage interest or rent, utilities, homeowners insurance, repairs and maintenance. Now, the key here is that word exclusive. If your home office is also your guest room, your kid's homework space, and your Amazon return center, it's not going to qualify. But if you've got a dedicated area, if you've got a dedicated area used solely for business, even a portion of a room, it could be deductible. And you can choose between the simplified method or the actual expense method, depending upon what gives you better result. Next up is health insurance premiums. If you're self-employed and not eligible for a group plan through a spouse, your health insurance premiums and those for your spouse and dependents may be fully deductible from your taxable income. This includes dental and long-term care in many cases. And that's just not a deduction. That's a meaningful savings opportunity, especially for people in their 50s and 60s where premiums often rise. Business mileage and travel. This one adds up quickly. If you drive for work, whether it's to meet clients, attend events, or check on properties, you can either track your actual expenses, gas, maintenance, depreciation, or use the IRS standard mileage rate, 70 cents in 2025. I recommend using an app or a digital log. It keeps the documentation clean and saves a lot of time come tax season. Business travel also counts: flights, hotels, meals, rental cars, as long as it's ordinary and necessary for your business. Pro tip, if you mix business and personal travel, the business portion is still deductible. Just keep records and stay honest. Number 4, hiring your kids. Yes, really. This one's a favorite because it's completely legal and surprisingly underused. If your child is doing real work in your business, i.e. social media filing, packing orders, customer service, you can pay them a reasonable wage. That money is a deductible business expense. And if they earn under the standard deduction, they may not owe any federal tax at all. Plus, they can use that income to fund a Roth IRA, starting their retirement savings decades early. That's a long-term win. Professional services and tools. Anything that helps you run your business more effectively is fair game. Accounting and legal services, marketing agencies or consultants, subscriptions to industry platforms or financial software, office supplies, postage, tech equipment. even continuing education if it relates to your field. It's not about trying to write off your whole life. It's about accurately tracking what's legitimately connected to your business and claiming what the tax code allows. The bottom line: track, document, and deduct with confidence. The key to all of this is not just knowing what's deductible, it's being organized and intentional. A few tips: keep business and personal expenses completely separate. Yes, that means separate bank accounts and cards. Use digital tools to track mileage and receipts. Review expenses quarterly, not just in April, because when your documentation is clean, you can take these deductions with confidence and avoid that sinking feeling of wondering what you missed, or worse, what might trigger an audit. In the next section, we'll talk about timing strategies, how and when you recognize income and expenses that can help you keep more money in your pocket year after year. Here's something most business owners overlook, and it's one of the smallest tools in your tax saving toolbox: timing. You don't always control how much money you make, but you can control when you recognize income and when you take deductions. And that timing, especially at year end, can be the difference between keeping more of your income or sending too much of it to the IRS. Let's walk through how this works in real life. You can delay income if you're cash based. If your business operates on a cash basis, meaning you record income when you receive it, you may be able to defer some year-end payments until January. Let's say a client owes you $20,000 in December. If you ask them to pay in January, that income shifts into the next year. You haven't lost the income, but you may have lowered this year's tax liability and stayed below a bracket. Of course, this only works if you don't need the cash immediately and you expect next year to be similar or lower in income. But if you had an especially strong year, it's a smart move. You can accelerate expenses on the flip side. You can pull expenses into the current year to lower this year's taxable income. That could mean prepaying rent or business insurance, purchasing needed equipment, paying for software subscriptions or maintenance contracts in advance, even making charitable contributions, which we'll get to in a second. As long as the expense is legitimate and related to your business, it could bring your income down for tax purposes before December 31. Example: one client of mine usually upgrades their computers every 2 years. Last year, we timed that upgrade in December instead of January, and the full cost was deducted on that year's return. It saved them several $1,000s right off the top. If you're contributing to a solo 401k or an SEP IRA, this is a great time to review how much you've already put in and what's left to contribute. Some retirement plans require setup before December 31, even if you don't fund them until tax time. Others allow flexible contributions after the year ends, but it's better to plan ahead, especially if you want the deduction now. By adjusting your year-end contributions strategically, you can reduce your taxable income and lock in savings for the future. Roth conversions and charitable giving. If this year is unusually high income or you're approaching retirement, you might consider a Roth conversion. You'll pay taxes on the converted amount now, but future withdrawals are tax-free, and you'll remove uncertainty about future tax rates. Pair this with charitable giving, and you could offset the tax impact with deductions. Here's a smart move for higher income years. Convert $30,000 from a traditional IRA, then make a $30,000 donation to a donor-advised fund or qualifying nonprofit. Your charitable deduction helps neutralize the conversion's tax hit. This strategy is especially helpful in years where income is high, but your lifestyle spending is lower, like before you take Social Security or required minimum distributions. You can clean up before the calendar turns. The final weeks of the year are a perfect time to review your books for unclaimed deductions, reconcile your bank and credit card accounts, make sure your retirement contributions are on track. Talk to your CPA or advisor or me before the year closes. Because once January 1st hits, you've lost the ability to shift most income and expenses. You can use time as a planning tool. Tax planning is about what you make. It's about how and when you make your moves. With a little foresight, you can structure year end intentionally. You can lower your taxes now, free up cash flow, and keep your long-term financial strategy on track. So don't leave this to chance. If you're unsure what to do before the calendar flips, now's the time to check in with your advisor or work with somebody who can help you make the most of every dollar. And that brings us to the bigger picture, because tax planning isn't just about the current year. It's about creating a long-term strategy that supports your business, your wealth, and your life. So, If you're a business owner, the question isn't, can I pay less in taxes? The real question is, am I using every tool available to do it legally, smartly, and in alignment with my bigger financial goals? Because the tax code is full of opportunities, but only if you take the time to use them with intention. So let's recap what we've covered. Using the right business structure, using retirement plans to build wealth and reduce taxable income, taking advantage of legitimate deductions, no shortcuts, just smart tracking, and using timing strategies to finish each year stronger. You don't have to work harder to keep more of what you earn. You just need to plan smarter. And if you're not sure of where to start, or if your current plan is as efficient as it could be, I'd love to help. If you're looking for a financial planning experience that's built around your business, your goals, and your lifestyle, book a call with me at the link below. Let's talk about what's next for you because it's not just about avoiding taxes. It's about building a future you actually want to live in with clarity, freedom, and peace of mind.